afternoon, everyone. My name's Patrick Malcolm. I'm a senior partner at GFM Wealth. Thank you to all our clients and guests for joining us today. We're going to get straight into things today, guys, because we've got a lot to get through. We've got a couple of funds we're going to talk about today. So I'm very lucky to have Nick Griffith from Munro Partners here today. Munro Partners is a global investment manager with a core focus on global growth companies. Established in 2016 by an award-winning investment team, the business is owned and controlled by key staff. The business is Australian domiciled with its head office based in Melbourne, which is a little bit unusual for a fund manager, but we'll take it. Nick is the founding partner and the chief investment officer of Munro Partners. He's responsible for Munro's key investment funds, investment management, and the formulation and implementation of the proprietary investment process. Nick has over 20 years of financial services experience and over 15 years of experience managing absolute return mandates focused on global growth equities. Nick holds a Bachelor of Commerce with honours from the University of Melbourne and a graduate diploma of applied finance and investment. The fund that we're talking about today, or one of, the Munro Global Growth Fund, has averaged 13.6 per annum since inception. Now, before I introduce Nick, I'm just going to share our disclaimer, which we always need to do. And this is effectively saying to all our clients and guests joining us today that the advice provided today is general in nature. If you want to discuss this investment in particular and its relevance to your financial situation, please call an advisor in our office to discuss further. So thanks for joining us today, Nick. It's been a good weekend for both of us. Both our football teams won, which is a little bit unusual. I went back to last year, and would you believe in 23 rounds that only happened once? Did Carlton and Collingwood win in the same round? I hope it happens a few more times this year.
Yeah, look, I was actually very excited to see Carlton winning, which is very strange for a Collingwood supporter, but it was a very exciting game to watch, and I thought Carlton played very well.
Good. Okay, so just to start with, I guess start with the fund to differentiate it from other long-only funds in the market, Nick. You obviously describe this fund as being an absolute return fund. Just for our clients and guests, could you perhaps explain how that is different from your traditional long-only international share fund?
Yeah, okay, great. And thank you, Patrick, for having me along, and thank you, everyone, for dialing in. And so as Patrick said at the start, we are Munro Partners. We are a global equity manager, and our core focus is growth equities. Our tagline is invest in the journey, because growth equities is a journey. It always is. Yeah, our job here is in your portfolios is to identify and find the world's greatest growth companies and try and find that growth in equities that you can't get in the Australian market. So you can't invest in semiconductor companies, you know, lots of different parts of healthcare, et cetera. That's what we do. The absolute return component, I will just show you a couple of quick slides really quickly. This is our main absolute return product here, which is the Munro Global Growth Fund. The key thing about the absolute return product is it's very much index unaware. So we have the ability to move the currency and the equity exposure around. We don't have to be fully invested all the time. What we're trying to do is provide you with access to those growth equities, you know, with some downside protection along the way. We do run traditional long-only funds. They're on the right here, which is our long-only global fund and our long-only climate fund. We might talk about them later. But our absolute return product is really designed to do one thing and one thing only. And I'm pretty sure something that's very dear to everyone's hearts on the phone calls here. And this just shows you the performance of the fund. It's designed to give you double-digit returns through the cycle. So it's trying to give you a 10% per annum return after all fees and expenses on a 3 to 5 year view. And so what we're saying is we don't compare it to the index because the index is fully invested all the time. And if you compare to the index, you know, your fund would be fully invested all the time. And I suppose what I find generally with certain clients is, you know, their relative return on the way up and absolute return on the way down, if that makes sense. And so what we're trying to do here is balance that scenario for you and give you double-digit returns through the cycle. That's what the fund's managed to achieve now for 5 years. It's not a straight line, hence the invest in the journey, but over the journey we have managed to do it. And we've actually managed to do it for 15 years because we have a 10-year track record prior to our time at Munro of doing more than double-digit returns through the cycle. And I suppose that's the key difference between, say, an absolute return fund and a relative return fund, Patrick. And that's
so one of the tools that you've got at your disposal, Nick, is obviously the ability to short sell.
Yep.
And I remember us catching up 12 months ago. Short selling was very topical because we've had all the game shop stuff going on. But can you just talk through how the fund or this portfolio uses short selling in the sort of construct of the whole thing, so to speak?
Yep, 100%. So as we said at the start, we are growth investors, and so most of the time we are working on the stuff in light green there. So most of the time, we have an investment process that follows, an investment philosophy. We're picking stocks. We're mainly picking growth equities with high conviction. So that's, do we invest in NVIDIA? Do we like Amazon, et cetera, et cetera? This is what, essentially makes us our money through the cycle, finding these great companies. And I'm sure we'll spend a lot of time talking about that today. What this product also has is the stuff in dark green. And so these are our tools we call capital protection that we use to smooth the cycle. And what I was trying to show you earlier is it is smoothing. It's not, we can't guarantee you the fund won't go down, but we have managed to smooth the cycle through the period. And so one of those things is short selling. Another one is just holding a bit more cash sometimes, which a lot of long-only funds can't do. Another one is buying put options, which we did very successfully through the COVID crisis, for instance. And another one is managing the currency situation. And so in terms of short selling, it's important to stress, and this just shows you just graphically a good way to think about how we've done this. The dark line is the net exposure of the fund over time, or the net equity exposure to markets. And down the bottom, you can see the short exposure. And so shorting is something we can do. It only makes up really 10 to 20% of the fund at any one time. And the fund exposure can range between, like, say, 100% or as low as 20%. And so we can move this exposure around either A, through short selling here, or B, through things like put options, or C, through things like cash. Specifically on when it comes to short selling, the best way to think about short selling is it's something that's quite useful in bear markets, like we're a little bit like what we're going through right now, or like we went through when COVID hit here. You can use it to try and make a bit of money to offset what you might be losing on the other side of the portfolio. The best way to think of it is, and coming back to the footy analogy, is it's a bit like your left foot. You kick better with your right, i.e. going long is kicking better with your right, but sometimes you might need to be able to kick with your left. But important to stress, you can only make 100% out of a short. You can't make any more. You can make thousands of percent out of your long. So we just use it as a tool to lower volatility or to hedge out exposure, for instance. So say we wanted to hedge out exposure, we could just short NASDAQ futures, for instance, to hedge the underlying portfolio. And so that's what we do with it. And maybe last thing, just to show you really quickly, this is the March quarter of 2020. This is the December quarter of 2018. Every correction's a bit different. These are periods like the quarter we've just been through, or the quarter we're currently in, where markets are difficult. We're not immune from our stocks going down. That's what happens when equity markets go down. Your longs generally go down. But all that you can see offside is what offsets that. So if we go to March 2020, the longs lost 12%, the shorts added 6%, put options added 6%, currency added 7%. 2018, it wasn't as good. Shorts added 2%, options added 2%, FX added 1%. Unfortunately, this correction that we're in right now is much more like this than this, as many people would have noticed. Our longs are going down more, and our hedging is not offsetting as much as we'd like, mainly because the market's just not going down in a straight line like it was here. But shorts have been helpful, options have been helpful, and the currency has been very unhelpful in this correction. But that's sort of a way to think about how we would use shorts to smooth the ride in the portfolio and ultimately lead you towards this outcome of double-digit returns through the cycle.
Good. I love the left foot analogy. I'm going to pinch that one. So one of the things that you really focus on in the commentary on the fund, Nick, is around breaking the portfolio into areas of interest rather than GICS interest. And I know lots of clients that look at the fund, Nick, find this very interesting and quite sensible. So can you talk about the concept of an area of interest and why you think about investing in that way?
Yeah, thank you. So ultimately, Munro Partners is built to be your global growth investor. So you have a choice for global equities and a choice for global growth, and our job is to be a global growth investor. And so when we think about investing for growth, we just think very simple philosophy that earnings growth will drive stock prices. So generally, we find companies that grow their earnings over time, their share price will go up. That's not meant to be a profound statement, by the way. Sustained earnings growth is worth more than cyclical earnings growth, and the market will always misprice growth and its sustainability. And so we're showing you two companies here. One's Bank of America. The black line's the share price. The blue line, the grey line, sorry, is its blended forward earnings per share. MasterCard, black line's the share price. Blue line's the blended forward earnings per share. And so when I first started doing this 20 years ago, we sort of came to the conclusion that, trying to work out what the economy was going to do every year was a bit of a mug's game, quite frankly. And trying to work out what interest rates were going to do was a bit of a mug's game. Everyone had a view, but you didn't have an edge. And so from our point of view, what we tried to do is really focus on the MasterCard situation, try and find those big structural growth opportunities here where the earnings would follow the share price. And so MasterCard is a classic structural growth opportunity, i.e. it's the shift from physical to digital cash. The earnings grow structurally, the share price follows it. And so the earnings of the areas of interest, Patrick, are really just designed to identify what are the big structural changes in the world today. If you're looking for a MasterCard type situation and you're trying to ignore a Bank of America situation, what we tried to do is basically say, well, let's just build a universe of MasterCard type situations. Where else would we find that wonderful structural shift? Because that structural shift will equal earnings growth, and that earnings growth will equal share price growth, which will drive people towards those double-digit outcomes that they're looking for. So what we did is we took the global equity universe, which happens to be over 30,000 companies. We have no hope of covering them all. We only have 20 people. And we basically said, well, out of that universe, how much is growing? And a whole bunch is professing to grow, but it's all growing because of cyclical factors. Iron ore prices are up, oil prices are up, or the economy's better. And while we like those companies and we understand, it's just not where we're going to get the best risk return outcome. What we've really focused on is our structurally growing universe, companies that we think can grow independently of the economic cycle. That universe is just 1,000 stocks, and we split it into these areas of interest. And the areas of interest, just to answer your question, they're not gig sectors. MSCI is going to do a really bad job of working this out because, like everybody on this call knows, the world is changing, right? The world is always changing. And so your job is, let's identify the structural change and let's identify the winners. And so whether that's e-commerce, which is clearly a big change of the last decade, or whether that's high performance computing, which is high in semiconductors, we think it's a big change in the next decade. Cloud computing, the shift to the cloud's been a big change really since about 2015, or climate change, which is clearly a big change for the next 30 years. These are all big structural changes. They're all good places to look for that MasterCard type situation. And so that's how we organize our world, because we know that our job is just to find these few great winners. Maybe just a last slide, just to really drive this point home. And something I may have showed before, and apologies if you've seen it before. But
no, it's a great slide, this one.
But I think the thing that is often missed, and it really is at the core of what our products are designed to do, is people will invest in the equity market, and they literally spend, and you're seeing this a lot right now, by the way. You're seeing a lot of people who will literally try and connect the equity market to the economy. I'll say the economy is going to do this, so the equity market has to do that. So you have to be overweight cyclicals, you have to be underweight defensives, you've got to be overweight financials, you've got to be underweight this other sector in some other country. And we would argue that that's a total waste of time. The reality is the equity market is made up of very few winners. Very few companies create all of the returns. This is a good study done by a guy called Henrik Bessenbinder. He basically said, what would happen if you bought and held every company in the United States listed over the last 90 years? And in that 90 years, 25,300 companies listed, and less than 4% of them create all the value of the market. And the top 50 make up nearly 50% of the market. So that's 50 companies out of 25,900 are responsible for 50% of the S&P returns over the last 90 years. This is a game of few winners and lots of losers. It's not about going over on underweight sectors. Your job is to find the few winners. And if you look on the right here, just really quickly, it's always the structural change that creates them. So these are those top 50 winners. These are the companies that are responsible for half the value. And it's always the same. This is time in months. This is annualized returns. There's a big structural change being digitalization, i.e. the internet came along. Amazon, Facebook, Google were the big winners. There's a big structural change with software. Microsoft and Oracle are big winners. Big structural change with big box retailing. Home Depot and Walmart come along. Quick service restaurants, entertainment, aerospace. It's always the same. There's always a big structural change, and then there's always a few big winners. Apple, smartphones. And so our job as your growth manager is really to occupy this top left-hand corner and say, what are the big changes that are happening in the world? And then let's split them into these areas of interest of the big changes that we think are happening. And let's go and try and find the winners. And if we can find those winners, that will ultimately what drive us towards the double-digit returns, and it'll happen completely independent of the economic cycle. And so that's why we love it from a risk-adjusted point of view, as just as a great way to think about the world and a great way to invest.
Seems like a pretty compelling argument against indexing, but nonetheless. Nick, you touched briefly before on recent portfolio performance. It goes without saying it's been a tough environment. Can you just talk us through how the fund has perhaps performed in the last few months, and your views on the market at the moment?
Yep, 100%. So obviously we are in a drawdown at the moment. I flagged this earlier. As far as drawdowns go, it's definitely much more of a 2018 style drawdown than a COVID style drawdown. So it's not an exogenous shock that we can effectively hedge against like we did against COVID. It's been sort of this slow bleed out of growth equities with a market that's sort of bouncing around. So it's been a bit more of this sort of drawdown than this sort of drawdown. From that point of view, the fund is roughly, I think, 11 or 12%, 11% below its peak at the moment. That's pretty normal for us. We did do that back in 2018, and over the last 15 years of money, that's reasonably normal for us. From our point of view, we were caught a little bit by surprise by this. We knew the Fed was going to hike rates. We'd spent a lot of time adjusting the portfolio, to bring it to the highest quality stocks. So I'll just show you really quickly, and I'm sure we'll talk about this a bit more. But this is a good graphical representation of the fund over the last 12 months. This is the revenue growth, and this is the free cash flow yield of some companies that are in the fund today. And the grey ones are stocks that left in the last 12 months. And so we knew that the Fed would hike rates. We knew that rates would go up. And so we spent most of last year removing all of these companies in grey from the portfolio. A, because we'd made good money on them, and B, because we felt that they would struggle in a rising rate environment. And some of them actually, triggered early last year in some of the wobbles that we had around growth. So things like Atlassian, The Trade Desk, Uber, Square, Spotify, they've all long since left the portfolio. And so we came into the year with this group of companies that we thought had a very good chance of structurally growing their earnings, and we still think they do, and had free cash flow yield support versus, say, a Fed that was rising rates. We have been a little bit surprised that that as we came into the year, this portfolio was actually holding up very well in the second half of last year. As all these growth equities, the growth unwind had actually been happening all through the second half of last year. And so if you looked at, say, some of our peers, or if you looked at high multiple tech stocks, they'd been coming off all through the second half of last year, whereas this portfolio was holding up very well. Unfortunately, come January, the whole market decided to get worried about the Fed. The whole market, obviously, we had a war in Ukraine that we didn't see coming. And so from our point of view, very early on in January, we decided to lower exposure of the funds. And so some of you would have noticed in the monthlies, the portfolio is sitting at roughly 60% invested. So we raised roughly 40% cash about the second week of January. And we've been sitting with that 40% of cash ever since. What that's done is it's lowered, you probably noticed it's lowered the volatility of the portfolio. So as we got into, even though January was obviously a difficult month for us, as we got into February, while other funds were falling, we weren't falling as much. And you've probably noticed this month, we haven't fallen as much either. In fact, we're flat. And so from that point of view, this cash just helps you weather the storm. It helps you not do anything silly in what's clearly a bit of a washing machine environment. From our point of view, we will look to put some of that cash back to work. We had put a little bit of it back to work before last week, but definitely not all of it. We still think it's probably a bit of a washing machine environment. These corrections do come along. It can't be easy all the time. You just need to manage these periods of volatility, but ultimately we're looking to put that cash to work in some of the areas that we really like. Once the market, or once people, quite frankly, get less transfixed about what the Fed's doing or what geopolitics is going to do, because these are two things that you can't really predict, and they really don't have that big an impact on the earnings of the companies we're investing in, but they do have an impact on the multiples. And so the multiples have been coming down. That to us is an opportunity, and we are poised and ready to take advantage of the opportunity as it presents itself over the months ahead.
And by washing machine, Nick, is that a reference to there being more to sort of play out in terms of what's going on at the moment, or?
Yeah, so from our point of view, generally when these periods come along, having been through a lot of them, there's sort of three things you're looking for. One, you're looking for the Fed to sort of central banks to stop hiking rates or stop increasing expectations of rate hikes. And I think that's the reason why the market bounced last week, because the Fed basically said what the market had already priced in. So if you think about it, there's a good way of thinking about this actually. So I'll show you. So the big kryptonite to equity markets, as is the same as the property market, it's interest rates, right? If you look at this slide here, this is what the FOMC was pricing in for rate hikes in March 2021. This is what they're pricing in for December 2021. And yesterday or last week, they told you that they're pricing in this. I haven't put the line on the chart yet, I'm afraid. I apologize. But they're now saying they'll get to 2% by the end of 2022. So they've gone from pricing in no rate hikes to pricing in 2% of rate hikes in the space of 12 months. That's a headwind for equity market multiples. Because, if the interest rates are higher, the alternative's better, multiples are a headwind. And that's why you've seen the multiple of the market coming down. But in many cases, earnings estimates haven't come down yet. So from our point of view, the first thing you're looking for is for all of these hikes to be priced in. And I think from that point of view, you probably got a tick last week. They've said 7 rate hikes, the market's at 7 rate hikes. So we've established the framework for them to start coming backwards, if that makes sense. Second thing you're looking for is companies to get cheap enough where you're happy to buy them sort of no matter what. That happened a little bit through this period, but it's important to recognize that, we have had a really good run here. We've had a good run for a good part of 2 or 3 years since COVID. And so even though the market has pulled back, in theory, it could pull back further to get to the level where you just close your eyes and say, I'm going to buy this stock no matter what. The last thing I just refer to on the washing machine is just generally when these corrections happen, and you've seen it a lot, is the market becomes very, very volatile. And it has, like literally, if I think about last week, I can't think of a day that the NASDAQ wasn't up or down 2% in the last 10 days. It's been very rare. There's maybe been one. And so you've got these down 3, up 2, down 3, up 2. It's not happening in Australia, but it is happening offshore. And that's just a sign that speculative cash is being flushed out of the system.
Yeah, okay.
And so from our point of view, that's a good thing. It's a very healthy thing to get all that speculative cash out. But also from our point of view, I just want to point out that, if you go diving in and say this is the bottom, you could be wrong within 48 hours. Does that make sense? And so what you should do is just be a little bit conservative, a little bit cautious. Bear markets are normally short and quick and nasty. And there's also these little bear market rallies along the way. Bull markets last a long time, generally years. And so from that point of view, our job here is just really to be conservative, to protect capital, keep the drawdown, as I said, to roughly 10%, and ultimately set ourselves up to go back into making the good years of money. And so from our point of view, maybe I'll go back to the performance slide. Having done this for a long time, what you're doing in these difficult years like we had here in 2018, where we only made 3%, this year, we're on track for -5. If we can keep that somewhere between -5 and +5, that ultimately sets you up for the 20% years.
Of course.
Because you've flushed all the speculative cash out of the market. And as I said at the start, it is a journey. Unfortunately, it's not a straight line to double-digit returns, but these years, it can't be easy all the time. These years are always going to come along, and that's fine. But your job is to be disciplined through them, and which is what we're doing. And then secondly, they set you up for the good years that are clearly going to come. Because what I always talk about, and sorry if this sounds like a bit of a platitude, but remember, when it's hard, sometimes it's just hard. Just accept it's hard. But don't forget that the sun will shine again. It always does. Markets will get easier. Life will get easier. So why would you go out and take all this risk when markets are very difficult? It doesn't make any sense. You're just going to lose a bunch of your clients' money and not have any P&L left for when the fun starts again, and it will.
Understood. Now, a really quick one. Nick, you talk about interest rates. I guess there's a view out there that perhaps in a rising interest rate environment, that makes things more difficult for these higher multiple, higher growth companies because you're pulling more of their future cash flows back into smaller numbers in present dollar terms. Your view on growth in a rising interest rate environment, Nick?
Yeah, so we'd agree. To a certain, so 2 things I'd say. One, most of the rate hikes are now priced in.
Yep.
So all of these companies on the right that were the high multiple stocks, they've all fallen a lot, like 60 to 70%. And thankfully we haven't been caught in them. they're probably closer to the bottom than they are to the top, if that makes sense. Now,
Yes.
I'm not saying you buy them today. They could probably hang around here for up to a year. But most of that damage around the multiple has been done from our point of view. We think back here where you're buying growth at a reasonable price, the reality is the structural earnings growth will outweigh whatever the multiple can do. So maybe the multiple comes down a bit further, but it's important to remember that all of these companies have huge pricing power. So they can, Microsoft can raise their prices, TSMC can raise their prices, Amazon can raise their prices. They've all got these big structural tailwinds behind them, be it e-commerce, be it cloud computing, be it digital payments. And in many cases, you're only paying, mid-20s multiples, 23, 24 times earnings. Their net cash, and they can grow their earnings pretty much regardless of what happens to the economy. And so from our point of view, what we think is we would definitely agree the high multiple stocks are going to struggle, but don't let that tar the same brush with these other things that are still, very reasonable prices and upgrading earnings. At the end of the day, people are going to try and jump from one sector to the next to the next. They're going to say, oh, we've got to be at a high multiple. We've got to be in commodities. Oh, we've got to be in banks. Oh, we've got to be in defensives. Or we've got to be here. They're going to end up back here. They will always end up back here because in the end of the day, as I said at the start, earnings growth drives stock prices. These companies here have earnings growth, tech. Secondly, that earnings growth is resilient, which I'm happy to talk about. And thirdly, you're not paying that much for them. And no one on this call, as far as I'm aware, is really excited about throwing their money into bonds at 2.5% here, because 2.5% is not going to get you the return you're looking for. So you're going to end up back here looking for earnings growth to try and get that return you're looking for. And maybe that process has already started, but we've been pretty much saying that since the start of the year. There's no point hopping all over the place when you know you're going to end up back here. Just take a little less risk for a while, let the storm pass, and then ultimately position here for the next 3 years, because that's where the earnings growth is, and earnings growth will equal share price growth.
Hard to talk about the portfolio without talking about China. Nick, you got a bit of press about almost 7 months to the day about the portfolio positioning in China. From what I understand, the fund got to about 15% or could have up to 15% of the portfolio invested in China. You're pretty much out now. Can you talk us briefly through your thoughts on China and sort of how you came to that view a little while ago about exiting the portfolio's positions in that area?
Yeah, so China was about 15% of the portfolio entering 2021, and by May we'd sold it all last year, and we haven't come back. Why did this happen? So remember, we are growth investors. So if you believe what I said at the start, and we do, is that it's a game of very few winners and lots of losers, right? So your job is to find these few winners and run them for long periods of time. You are going to make mistakes. It's inevitable. This just shows you our top 10 winners since inception in basis points contribution and our top 10 losers. What you can see is our winners far outweigh our losers. Why? Because we run formalized stop loss procedures. So any company that falls 20% from peak or from cost, subject to a review. I strongly encourage people on this call to adopt this policy. It works very well for us. You don't have to sell the company. You just have to check if there's something wrong. And you've got to check thoroughly. Because you are going to make mistakes. You just are. The Chinese stocks all triggered. The anti-IPO got pulled in December 2020. By March of 2021, Alibaba, which was our biggest position, was triggering. It had fallen 20% from peak. We'd made a lot of money on it. As you can see, it's not one of our biggest losers here. And we reviewed it and we decided, there's nothing wrong. It'll be okay. But under our rules, we can only keep it for 30 days. And if it's still triggering, we have to review it again. And so by April, we're reviewing it again. And we're like, okay, the closer we're looking here, we can sort of see what the problem is. It's a regulatory problem. The government's basically changed their soft touch to a much harder touch. We reduced the position, and by May, it's triggering again. And by May, we decide to sell it all. And the reason why we sold them all is because we couldn't put our hand on our heart and say, what were the earnings of this company going to be? We didn't know what the Chinese regulatory authorities were going to do. They were investigating these companies, fining them. The companies were paying the fines and thanking the regulator for fining them all within the space of 6 weeks. And not just for, $10, billions of dollars. And so we had no idea what the earnings were going to be. We couldn't say with confidence that we could defend the position. And so we sold them. And then a journalist happened to ring me at around the time we did it. And I said, I think everyone's being really complacent here, because the more people look at this, the more they're going to come to the same conclusion. And now what you've seen then is basically everyone else going through exactly the same process we went through, which is you don't actually know what these companies are going to earn because you don't know what the regulatory regime is going to be. So why are you there? Like, why are you there? Even if you hate Facebook, Facebook at least can appeal to the court. They can appeal to the Supreme Court in the US and protect themselves. And these Chinese companies can't. And so we've left. It's going to take a lot to get us to go back, because the PE multiple doesn't really matter if you don't know what the E is. And you don't know what the E is because you don't know what the regime is. And that's just the wonders of investing in a communist country versus a capitalist country. And people just seem to have forgotten that for some reason.
We're going to pick out a stock, Nick. Innovative health is obviously one of the big areas of interest, and Danaher is one of the largest positions in the portfolio, the Global Growth Fund. Can you talk us through the Danaher business and what it does?
Yeah, so thank you. So at the end of the day, I mean, this is the fun stuff, right? So these are the areas where we see strong structural growth in the years ahead. This appears
macroeconomics is not fun. It's picking stocks that's fun, Nick.
Yeah, correct. Macroeconomics is no fun, and it's hard, right? It's really hard. The reality is picking stocks is much easier, and their earnings will grow, and eventually their share prices will follow their earnings. That's pretty much what happens every time. In your monthly reports, this appears pretty much every month, and definitely in the quarterly. It shows you the weight that we have to each of these areas of structural growth. So innovative health, you're right, is the biggest, is 12%. Number of holdings, of which Danaher is the biggest. And below that, you can see high performance computing, digital payments. These are the areas of big structural growth. These are the holdings. These are the companies that we think will benefit from that structural growth. That'll give you earnings growth. That'll give you share price growth. And everything else is just eradicating the mistakes along the way. Danaher is actually the biggest position in the fund today. And it's really benefiting from this one big structural shift we see in the world, which is the shift to biologic drugs. So as we get better in the drug industry, biologics are taking a bigger and bigger share. You can see at the bottom here from, say, a normal drug. And so these are things like biosimilars. They're things like mRNA vaccines that we've all had recently. And these are all grown in things called cell culture and different cultures. And so a biologic basically goes through a cell culture, chromatography, filtration type process. They're very different drugs. A lot of these areas are sort of single use. And so what Danaher is, it's sort of the weapons manufacturer in the war of creating biologic drugs. And so as we go faster and faster into these biologics and into these different areas where these drugs will work, and as we start using even things like biosimilars, as some of them start to come off patent, you need more and more of this equipment to make these drugs. A lot of this equipment is single use, if that makes sense. So you have to do it in one vat and let the cultures grow, and then you have to throw it away and do another one. And that just creates this really great recurring revenue model for Danaher, because they effectively are the largest supplier of all these products globally. And so there, when we look at Danaher, these are some of the equipment that they make. On our quality score, it's an 85% company. The PE multiple is a bit lower than that now. We're paying roughly 25 times earnings for a company that's going to grow its earnings double digit for a very long period of time. You can see down the bottom here, here's the earnings growth over time versus consensus. So that's blended forward EPS, and there's the multiple. So we're still paying roughly the same multiple we paid for the company in 2019. The earnings are continuing to grow. The multiple may go down a little bit more, but I'd be surprised. The earnings, we're pretty sure, will continue to grow, and the share price will follow the earnings. And so that's why we like Danaher. It's a big play on this completely recession-proof area called the shift to biologic drugs.
Massive company, Nick. Market cap of 211 US, 300 billion. That'd make it the biggest stock on the ASX, or second biggest, wouldn't it? It's huge.
Yeah, it is a big company. Look, we own this one in Thermo Fisher, which is also a big company. They dominate the healthcare equipment space. And we invest in companies much bigger than that. But no, we really like this one. It's been one of our best performers for a long time now.
Cool. Now, I know it wasn't quite the quote, but never let the truth get in the way of a good story, Nick. So the biggest investment trend of our lifetimes. Now, I think there could be the biggest investment trend of our lifetimes, but can you talk about what you think could be the biggest investment trend of our lifetimes?
The biggest next one, or the biggest one we're in?
Well, the biggest one we're in, Nick.
Well, the biggest one we're in is clearly digitalization.
Yeah.
Digitalization's pretty much underwritten my funds management career for a long time. The reality is we are working through a process of digitalizing everything on the planet. This webinar is a good example. Why is this happening? Because computer chips are getting faster. As computer chips get faster, more things get digitalized, whether it's payments, whether it's advertising, whether it's cloud computing, whether it's e-commerce. So that's definitely been the big driver for us in the last 10 years and continues to be today. And on top of that, we'd even take it one step further and go by the semiconductor companies. That's what high performance computing is the companies that are actually building the silicon that's driving this whole digitalization process. And without doubt, we see that, me telling you Amazon's a good company, it's probably not that interesting to most people on the call. But as you move into this silicon area and move into this AI area, we see companies like NVIDIA potentially becoming the biggest company in the world. And we see companies like AMD potentially joining them because they provide the silicon that's really driving this big digitalization agenda. Beyond that, and I think the thing you wanted to get me to get to, but
I was trying to steer you to climate change, Nick.
No, I know.
You do it very well.
Beyond
Sorry.
that, but I just don't want you to forget about digitalization.
No, of course not.
So beyond that, what we have said, and you're right, we have said, look, okay, so if we were looking for a trend that was going to be as big as digitalization was for you, right? And digitalization was, effectively underwrote my whole career. The trend that's clearly out there is decarbonisation. So decarbonisation has the opportunity to be as big as digitalisation. Why? Because it's going to just simply cost so much money to decarbonise the planet. And in our opinion, you have reached that tipping point of decarbonisation. And the reason why you've reached it is not because Australia is committing to a net zero target. You've reached it because every single corporate on the planet is committed to a net zero target. So BHP has a sustainability report out. You can download it. It's 130 pages long. It's audited by EY, and it shows you how BHP, one of the largest companies in Australia, is trying to get to net zero by 2050. And it means they're going to spend meaningful dollars on it. And so what we think is we think it's somewhere between 50 and 100 trillion dollars to decarbonize the planet. It's a very diverse opportunity, hitting things like energy efficiency, renewables, transmission, trucks, passenger EVs. And we think there's just a really diverse opportunity of companies that in many cases just trade at market multiples or are considered boring companies that we think will benefit from this trend. And maybe just to show you a couple of things really quickly, if you just think about electric cars, electric cars are the smartphones of 2020. Smartphones were 2000s, right? We used to, this is how many cars you sell in the world. This is how many electric cars you're selling at the moment. So not many. But it's inflecting. 30% of all cars sold in Europe in December were electric. 15% in China were electric. 5% in Australia and the US, I'm afraid. A bit more range anxiety. But from that point of view, this sets up exactly the same as the Apple opportunity did back in 2009. There was lots of mobile phones in the world. Smartphones came along and took all the share. Electric cars will do exactly the same thing. Obviously, that's driving Tesla. We think it can drive semiconductor companies again, things like onsemi that make the powertrains, that do the power semis, that really is what drive these cars. So if you think about a car, an internal combustion engine is all pistons and fuel. An electric car is all batteries and semis. Another thing we just flag, this opportunity can be as simple as packaging. The reality is we have to shift away from plastic and glass. You can shift to aluminium. Aluminium is going to take share. You're probably seeing water bottles now turning up in aluminium cans or aluminium bottles, etc. And so we would like a company like Ball Corp, which literally just makes a third of every can on the planet, like aluminium can. Aluminium is the most recyclable product on the planet. Earnings grow structurally over time as they shift share, and you don't have to pay too much for it. And it's just a really good example of a company that, once you get beyond all this noise that's floating around at the moment, it's reasonably clear to see this company will continue to grow. It's reasonably clear to see you're not going to pay too much for it, and it's somewhat recession-proof. So why is it not a good place for your money? And so that's the cost of blanche of all these companies we look at. Apologies, I went off on a big.
No, that's okay. No, and just to make the distinction for our audience as well, Nick. So obviously, climate is a sleeve of the Global Growth Fund of the absolute return mandate, but You've also got a unique climate change fund, long only, that just invests in the climate change thematic?
Yes. So as you can see, it's a sleeve down there of the long short fund at the moment. About 5%. It's a bit bigger than that now. Actually, since the slide was done, it's about 8% today. But thank you, to your point. I mean, so obviously we've done the absolute return product today in the call, and that is our global equity product. It's our global growth product, looking across a range of different industries, be it semiconductors, climate, digitalization, etc. We have, as you write on the far right, chosen to set up a standalone climate product, just 15 to 25 companies, fully invested all the time. So this is a long only product, by the way, so it's going to be more volatile than you might be used to from this product. But importantly, I suppose it's just our way of saying, look, if you think this is as big an opportunity as we do, and you want to step out and add to it, this is a satellite product that allows you to lift your exposure.
Can you talk us through the 4 segments that you've sort of divided the climate thematic into, Nick? I find that really interesting. Sorry, I've just taken you from the back of the deck to the front of the deck.
No, you've taken me. It's okay. I'm just checking if I've got the bits I was looking for. Yeah. Yes. Okay. So drilling down, if we look at that opportunity for the climate fund, and we do this for the main fund only, we sort of said this is a big opportunity. It's going to touch most industries in the world. We've sort of split it into 4 segments, and the climate fund is invested in all 4 today, and that's how we diversify the climate fund. And so the most obvious segment for decarbonising the planet is clean energy. So that's companies that develop renewable energy facilities, or companies that make wind turbines, or make like Vestas, or make hydrogen products like Air Products. That's the obvious one, and I think a lot of people understand that. Less obvious is energy efficiency. So more than a quarter of the gains we're going to get is by making buildings more efficient, by making your home more efficient. You can't actually sell your house in the UK anymore unless it's 5-star energy rated. They won't let you. You'll have to pay extra stamp duty, etc., on your site.
And I think when you build in Victoria, you have to have a similar thing.
Correct. And so from that point of view, companies like Kingspan that make insulation, Train Technologies that do air conditioning, you've got to think about what's going to happen to your hydronic heating. You're going to switch to heat pumps, etc., electric switches, etc. These companies are big winners and traditionally quite boring companies, very low multiple, that have this huge structural tailwind behind them now. It's quite funny when you talk to them, to give you an example. So Train makes air conditioners, right? They make heating, ventilation, and cooling equipment for buildings. And we spoke to them and the funny conversation, we're like, how would you talk about the opportunity? And they said, the simple way to think about the opportunity is, I've been in this business for 30 years, and normally only people would call me if something broke. Like that's when you call someone, when your heating's broken or your air conditioning's broken. He says, now people are calling me because they want to lower their carbon footprint. It's a completely different conversation. So that's energy efficiency. Clean transport is Tesla and all the supply chain underneath it. And the last area we'd flag is just is circular economy. Circular economy is super exciting. These are the companies that are going to help with the recycling, how we do carbon credits, etc. This is the circular loop that we're going to have to create, because there's just not enough resources in the world to keep the world growing at the rate it's currently growing. And we think with these 4 areas, we can A, capture the opportunity, and B, balance the climate portfolio a bit. So it's just not all a whole bunch of zero revenue technology companies, so to speak. It's a bit more of a balanced investment.
Understood. Well, last question for the day, Nick. Can you do you have any data on how the portfolio ends up looking from an ESG perspective, in terms of sort of maybe its carbon footprint, or, compared to the index? Because it's something that people are certainly very conscious of.
Yep. The climate portfolio or the growth?
The climate portfolio, yeah.
Okay, I do. It's a question without notice. Hang on a second. Bang. Yes. Okay. So the climate portfolio, to be clear, this is how it indexes versus the ESG date rating versus Sustainalytics, which is one of the groups out there. And so, as you can see, from an ESG point of view, it outscores the index. But I want to be really clear here. We use the same ESG process for all our funds.
Yep.
We have our own responsible investment manager now called Mike Harut. And so ESG, while it's important to us, is not the key goal of this fund. The key goal of this fund is to invest in the companies that will enable the decarbonisation of the planet. And so, as I showed you before, same areas of interest that I showed you before. This is it split up amongst circular economy, clean energy, energy efficiency, transport. And the key thing we are trying to do here is really allocate the capital that you give to that fund to the companies that we think are solving this problem. And so Microsoft is clearly a great company. We love it in the main fund. It's a good ESG citizen, but it's not enabling the decarbonisation of the planet.
Of course. Yep.
We want to give the capital to these guys on the right who are basically avoiding CO2, who are accelerating the decarbonisation. And the last thing I'd just say is don't think that's mutually exclusive to not making money. How capitalism works best is when capitalism is solving problems. This is clearly a big problem. This is just a good slide showing Tesla over the last 10 years. This is the share price. This is the capital they raised. They had to raise nearly $20 billion from shareholders to pull forward the development of electric cars, which ultimately saw electric cars come decades before they otherwise would have, ultimately saw the company be very successful for its management and for its shareholders, and then help the planet along the way. And so it's important to stress that money that's allocated to this product is literally just going to go to the management teams that we think are going to solve these problems, because if they do solve the problems, that's going to equal really, really good economic returns for them and for our clients.
Understood. Well, thanks for joining us today, Nick. We always appreciate it. All the very best for the year ahead and moving forward in this tricky little spell in markets.
No, thanks very much for your time, and thanks very much others for dialing in.
Cool. All the best. Thank you, Nick.
Cheers.
Bye-bye.